You are looking at a stock that is flashing a falling trend and just brutal sell signals across the board. Yet, some of the smartest valuation models on Wall Street are calling it massively undervalued. So, what is the real story here?
Yeah, it is the ultimate market paradox right now. I mean, you have order flow data pointing in completely opposite directions.
Right.
Plus, you've got structural changes in the core business and a massive catalyst just looming right on the horizon.
We are putting Tesla under the microscope today, ticker symbol TSLA. As of today, which is April 16th, 2026, it is trading right around 388 bucks a share.
Yeah, 388 and some change.
Exactly. And the urgency here is that next Wednesday, April 22nd, they hold their Q1 earnings call. The signals ahead of this call are honestly some of the most conflicting, bizarre metrics I have seen for a mega cap company in a really long time.
The tension here is totally structural. You have the raw, capital-intensive mechanics of a legacy car business crashing head-on into the highly speculative future of artificial intelligence.
And all that friction is playing out live in the options flow.
Right. Exactly. It's playing out in the options flow and the institutional positioning.
Okay, before we rip into the data, if you are taking this deep dive with us on our YouTube channel, make sure to hit that like button, subscribe, and drop your feedback in the comments. We want to hear your take. Are you buying this dip or are you running for the hills?
And as always, a crucial reminder for everyone tuning in, this deep dive is purely for educational exploration only.
Right.
We are just analyzing data and dissecting public filings. Absolutely no financial advice is being given here. Your portfolio is your responsibility alone.
Okay, let's unpack this. Looking at Tesla's current stock chart is, it's like flying a plane where the altimeter says you are rapidly climbing, but the ground proximity alarm is just blaring at you to pull up.
That is a great way to put it.
Right, because on one hand, the stock is down over 4% in just the last month. It is a heavy short-term bearish trend, but then it spontaneously rips upward 7% on the recent news of their AI5 chip tape-out.
Well, that tape-out news isn't just noise, though. A tape-out actually signifies that the final design phase of the semiconductor is locked. It's moving into manufacturing.
Ah, okay. So it's a real milestone, not just a rumor.
Exactly. In the context of the global compute arms race, getting a proprietary chip of that scale to manufacturing is a massive de-risking event. The market reaction shows just how sensitive this stock is to AI compute capabilities.
Even while the broader automotive trend has been, kind of dragging the valuation down, before we talk about where the stock is going, we really need to know where the company actually stands.
Yep.
Let's look under the hood.
Yeah, let's look at the trailing 12-month financials. Top-line revenue is still an absolute behemoth. We are looking at nearly $94.8 billion on the TTM.
Wow. Okay. Almost 95 billion.
Right. But the real story, the mechanism driving all this volatility, is found in the margins. It is totally a tale of two margins here.
Okay, lay them out for me.
So their gross margin is hovering around 18%. That indicates they are still highly efficient at the physical manufacturing level, right? They know how to cast and assemble vehicles profitably.
Right, but what about the net margin?
Well, the net margin drops all the way down to a very tight 4.07%.
Wait, 4%. So that 14% delta is just vanishing somewhere between the factory floor and the bank account.
Pretty much, yeah.
I mean, I'm guessing that is a combination of aggressive price cuts to maintain volume against Chinese competitors, combined with astronomical R&D spend, like for the AI5 chip you mentioned.
That is precisely the mechanism at play. They are actively sacrificing near-term profitability to maintain market share and build out their compute infrastructure.
Which leaves them with what kind of earnings per share?
It leaves them with an EPS of 1.08 over the last 12 months. If we look at Q4 of 2025, net income came in at $840 million.
Okay, hold on. For a company carrying this kind of valuation premium, $840 million is an incredibly thin layer of profit.
It really is.
You're describing a company that is slashing its own throat on pricing just to keep cars moving, while throwing billions at silicon. That sounds like a recipe for a liquidity crisis.
Well, it would be if they were just a legacy automaker.
Yeah.
But their balance sheet is a fortress right now. As of the end of 2025, they hold almost $138 billion in total assets.
Okay, and liabilities?
Only about $55 billion in total liabilities. And crucially, their cash and cash equivalents sit at $16.5 billion.
Wait, so they have more cash than debt because their total debt is, what, around $14.7 billion?
Exactly. They literally have more cash on hand than their entire debt load. Plus, they brought in $1.42 billion in free cash flow in Q4 alone.
See, I have to push back here, though. A cash fortress is great, but I am looking at the source data on their core business. Automotive revenue is actually down 11% year over year.
Yeah, that is a stark drop.
It feels like they're a tech company trapped inside a struggling car manufacturer's body. I mean, selling 11% fewer cars is a massive red flag.
If we connect this to the bigger picture, that tension is exactly what the market is failing to price efficiently.
Hmm.
Yes, an 11% drop in auto revenue is a significant bleed.
A huge bleed.
But that balance sheet is exactly what is financing their massive pivot toward AI and energy to offset those automotive margin pressures.
Yeah.
They can absorb a cyclical hit because they aren't relying on debt to keep the lights on.
So the car business is essentially the venture capital wing funding the AI business at this point.
That's one way to look at it, yeah.
Let's take that thesis from the boardroom down to the actual trading floor then. We are sitting right around $388. We are floating in the dead center of this massive 52-week range.
Right. The low was 222.80 and the high was almost 499.
So where are the actual pressure points in the order flow right now?
Well, we are wedged between two massive tectonic plates of liquidity. Right below current levels, there is immediate support around 350.72.
Okay, and if that breaks?
If the price slips through that, there is a major floor at 343.24. On the upside, it faces immediate resistance at 374.71 and a really massive barrier looming at 394.81.
The indicators tracking all this momentum are just completely fractured, though. You look at the moving averages, and Tesla is holding above its 50-day average, which is around 354.
Which usually signals bullish accumulation.
Right. But then it's struggling right near its 200-day moving average, forming this ceiling up near that 394 resistance zone.
And the momentum oscillators are even more contradictory. The MACD is actually signaling a buy on the daily charts.
Wait, really? But I saw it was flashing sell on the shorter time frames.
Exactly. If you zoom into the short-term 20-day averages, it is screaming a strong sell. We see the exact same fight happening with the RSI trackers.
Right. Some feeds have the RSI completely maxed out at like 79.66, saying it's wildly overbought. But other trackers claim it is at a perfectly neutral 45.88.
It is completely bizarre.
Here's where it gets really interesting, though. It is like looking at a car's dashboard where the check engine light and the optimal performance light are flashing at the exact same time. How does that even happen mechanically?
It happens when different classes of market participants are fighting over the narrative. The short-term algorithms react to immediate price spikes, like that 7% AI5 jump.
Which drives the short-term indicators into overbought territory.
Right. Meanwhile, longer-term macro funds might be quietly unwinding positions because of that 11% drop in auto sales, dragging down the larger averages. It creates a massive volatility squeeze.
Which brings us to the who is buying and selling data. And this is the part that actually makes me really nervous ahead of the April 22 earnings.
The options flow.
The options flow is betting heavily on volatility, sure. But more concerningly, the insiders are dumping shares. Kathleen Wilson Thompson, a director, sold about $9.27 million worth on March 30th.
Yeah, I saw that.
And the CFO, Vaibhav Taneja, sold nearly $900,000 on March 6th. Why are they selling right before earnings?
Well, this raises an important question. Are retail traders getting trapped here? Retail buys into the AI5 hype, pumping liquidity in, while executives take profits ahead of a potentially volatile earnings call.
It feels predatory. Retail buys the rumor, drives the price into that 394 resistance wall, and then if earnings are bad, the floor drops out.
Retail often gets crushed in these high volatility squeeze zones.
Yeah.
Insider selling isn't automatically a panic signal. You know, they have tax obligations and scheduled plans, but the timing is what short sellers zero in on.
That leads us right into the whole undervalued versus value trap debate among the analysts, because the consensus right now is wild.
Oh, the analyst ratings are entirely split.
Yeah, across 28 plus analysts, the official consensus is a hold, but half of them say buy or strong buy. About a third say hold, and 18% say sell or strong sell.
And the valuation chasm between those groups is staggering. On the bear side, you have DCF and alpha spread models screaming that the stock is 88 to 213% overvalued.
Meaning they think it's a value trap.
Exactly. Some of these models point to an intrinsic value as shockingly low as 47.17.
Wait, $47. The stock is at $388? How can the smartest analysts in the world look at the exact same balance sheet and come up with $47 on one end and almost $600 on the other?
On the bull side, GF value and AI-powered narratives place fair value between $453 and $588. seeing a 26% upside or more.
That is not a difference of opinion. That is a completely different reality.
It comes down to what company they think they are valuing. The $47 valuation treats Tesla purely as a car company facing an 11% auto revenue decline.
Okay, so applying a legacy automotive multiple to shrinking margins.
Exactly. But the $588 valuation treats it as an AI and robotics monopoly. They're pricing in the tech.
So the bulls are banking on the AI5 chip, scaling high-margin recurring software revenue through FSD licensing, and the robotaxi rollout in Austin.
Don't forget the Optimus robotics program.
Right, Optimus. So the best-case recovery scenario relies entirely on hardware dominance and software margins, not selling Model Ys.
Yes. But we have to talk about the immediate downside risks, too. The short-term weakness is real.
Right, the bear case continuation. What happens if it goes wrong next week?
Well, if TSLA fails to hold that 348 support level, it could trigger a sharp technical drop toward 332 or even lower.
Ouch.
If automotive margins keep narrowing and that 11% revenue decline accelerates, the worst-case scenario is the car company reality, just violently dragging down the stock.
So what does this all mean for you, the listener? It really comes down to your perspective. If you are a short-term trader, you are playing a very dangerous game of earnings roulette right now.
It is a highly volatile setup for sure.
But if you are a long-term investor, you are basically betting on whether Optimus and robotaxis can replace shrinking car sales over the next decade.
To summarize all this, the balance sheet is a fortress, but the technicals are an absolute war zone.
That's a great summary.
The analysts are entirely split between an impending crash and a massive AI breakout. But I want to leave you with a thought we haven't fully explored, but it builds on everything we've talked about.
Oh, let's hear it.
If Tesla's future is truly entirely dependent on AI and robotics, at what point do we stop comparing them to Ford and Toyota? When do we start comparing their valuation directly against companies like NVIDIA and OpenAI? Because if that shift happens, all these legacy metrics are basically useless.
That changes the math on everything. Which brings us to a massive cliffhanger.
It really does.
Next Wednesday, April 22nd, Elon Musk takes the mic for Q1 earnings. With insiders selling millions and retail traders piling in on AI hype, who is about to get caught on the wrong side of history.
We are going to find out very soon.
We sure are. Thank you for joining us on this deep dive. Stay curious, remember to leave your thoughts in the comments, and keep digging. We will catch you on the next one.